Welcome, everyone. My name is Amrita Basu, and I head up TT's new initiative on training and user experience. Thank you all very much for joining this webinar on the TT Premium Order Types. This is the first webinar in our new series of webinars called TT Live, where we'll spotlight different TT products and features. For this webinar, we will go through an overview of the premium order types that are offered on the TT platform and speak to how these order types utilize historical and real-time data to influence order behavior. We will also discuss some practical examples of how implementing quantitative models apply to commodity derivatives. We'll end the session with a Q&A. However, if you have any questions while we are going through the presentation, please feel free to send them in, and we will address them as we go along. The webinar is going to be led by Matt Racine, who's the Director of Advanced Execution Services at TT. He has been working closely with users on integration of the premium order types into their workflows and training them on usage. Matt's background is quantitative portfolio and risk management. With that said, Matt, over to you.
Thanks, Omri, and thank you everyone for joining today. Excited to get to speak to you about our product. It's been about 9 months since our group was acquired by TT, and being able to integrate into the platform and continue working with the TT client base, including yourselves, has been a great opportunity. So as Omri mentioned, we'll primarily be going over the premium order types today. So I'm going to do a quick run through the different offerings within the premium order types, a quick discussion on some of the quantitative models we use, along with some examples specific to commodity markets, and then go through a live demonstration just showing everyone what the premium order types look like within your TT platform, and how you can use it within your existing workflows. So in terms of what are premium order types are an advanced execution tool meant to enhance your interaction with liquidity. Futures markets are obviously individual instrument markets. Unlike equity markets, you're not interacting with liquidity across a variety of different pools. You're really interacting with just the one central limit order book, occasionally some OTC block type trading, but really you've got that single source of liquidity. So how you interact with that is going to be very important in terms of your overall ability to minimize your slippage. Why are there multiple premium order types? From an execution standpoint, trading is never one size fits all. There's never going to be one specific algorithm or type of advanced tool that's going to identify the best thing in all cases. So it's really about having the proper tool set, understanding what is impacting your overall execution, and what can be done to influence that in a more positive manner. We work with clients on things like strategy selection. So which order type should I be using based upon how I'm trading? Some customers may have an idea of what that looks like out of the box. Some might need guidance. So working with them, understanding how people trade, what their economic need to trade is. So if you're a fund manager versus a commodity firm who has physical exposure, you may have different reasons, rationales, and risks that you're hedging. So it's really working on kind of providing something to help solve that problem. In terms of premium order types, what they're not a strategic trading model. It's helping decide how to best execute within the confines of the order type that you're using. It's not selecting what or when to trade something. So occasionally that gets a little muddled, and we like to make sure that there is that clear distinction. This is not something where you're trying to sell alpha or a trading strategy or a model for something like trend following. It's really helping optimize that overall execution problem. And one of the important things that comes in terms of how to best optimize that, which is going to tie into the quantitative intelligence conversation, is really product-specific modeling. As I mentioned, futures markets differ from other financial markets in that there's that single source of liquidity. The market microstructure is really a driving factor in a lot of the differentials between products in futures markets. You've got different matching engines, which I'll demonstrate some of the interesting nuances of how that looks in terms of the order book. But different matching engines, different seasonalities. So specifically with commodity markets, we're not looking at stock indices where you're typically looking at, you've got quarterly contracts, very heavily concentrated in the front month most active. You've got interest rate markets that have certain underlying economic reasons for how the forward curve looks. Commodity markets are going to have their own seasonalities, and those need to be handled differently. So you can't apply kind of a single one size fits all model. Specific to commodities, we look at things within different markets like, for example, in agriculture, you've got new crop, old crop differences, which are going to influence how different months trade as we're going through time and how liquidity is shifting between those. In certain energy markets, you've got the summer and winter differentials. You've got shoulder seasons when you're typically going to see some liquidity decreasing in comparison to some of those the summer and winter. You've got the issue of storage. You've got the issue of transportation. So you've got a lot of factors that are going to really influence the behavior of those markets from an order book and liquidity perspective. And all those are taken into account and looked at in order to improve the models that are basically doing our liquidity and volatility forecasting, interacting with the order book, reacting to changes to help influence your overall trading experience for the better. In terms of the offerings, we've got 7 premium order types out of the box available on the platform. You can look at these in many ways. One way I like to look at them is basically to bucket them in terms of what's driving them. So looking at the TWAP plus, VWAP plus, brisk, and close, I like to think of these as something that is somewhat built on a schedule, but with an opportunistic component. So TWAP plus, VWAP plus, quite common terminology in the industry. One executing linearly across time, the other one forecasting what liquidity is going to look like during my trading horizon. Brisk looks at what is commonly referred to as an implementation shortfall style. So looking to minimize risk-adjusted slippage. Risk-adjusted slippage, as our team defines and discusses it, is really the optimization between what a VWAP is looking to achieve, which would be minimum market impact, and the second component of minimum price drift. So if a VWAP has a very good forecast, which is what we're attempting to do with all of our quantitative modeling, and we're able to trade at the most liquid times within any given trade's window, that should be the minimum market impact for that trade. Brisk is taking that objective and trying to balance that with the risk that price might move while I'm trading. So I might want to trade faster. I might want to back off. I might want to fade the market with any of the given child orders that an order places. And the final one in this bucket is the TT close. This is commonly something that people would use for settlement time. We don't specifically restrict this to being used with settlements. You can really use it as sort of with a generic end time. But that common use case of settlement would be to target things, in terms of settlement, used as an alternative to TAS type trading. Often you get that greater liquidity pool in the outright futures. So it can be a useful tool in a lot of those situations. The other bucket that I like to think about things in is somewhat more reactionary and tactical. These are not going to be using any predetermined scheduling. They're not going to be forecasting necessarily the overall liquidity curve. They are going to be using a lot of the same features that we're looking at in terms of order book dynamics. So when child order placement's occurring, we're doing a lot of forecasting and looking at the micro price and the order book skew, and basically attempting to determine what the market's going to be doing. Is it going to be moving away from me? Is it going to be moving into me? And then reacting to that. So working passive orders, trying to get passive fills is all highly correlated with good execution metrics. So trying to maximize or optimize those opportunities while being able to take liquidity when it's advantageous and the price may move away. So in terms of reactionary and tactical, it's really more being driven solely by those order book dynamics, less so by the overall market forecasting. So the TT POV and the TT scale POV are similar in nature. One is tracking a target participation rate. The other is just tracking a range, so a min and a max, and then depending on what the market dynamics are, trading higher or lower within that range. The final order type is our TT Prowler. This offers a number of different features. In its most simple use case, it looks like an advanced iceberg order type. So randomizing sizes between a min and a max. It offers a number of other behaviors that a lot of customers find very useful. Icebergs are very common. It's a common source of hidden liquidity in order books. And a number of commodity markets, it seems to be the most used synthetic order type in many cases. So taking that iceberg features and then adding in things like passive posting, multi-level posting, and sniping capabilities really gives users a tool to influence a behavior they might have a better understanding of, but adding in the ability to take advantage of liquidity opportunities. So I'm not just sitting statically at a single price level. I can be dynamic around if that price is moving, sticking with the market, and also looking for advantageous opportunities to take liquidity as it appears on the order book. And if liquidity appears on the order book, as I'll go through in some of the quantitative intelligence conversation, it is something that you typically are going to want to do. Especially top of book, if you're trying to minimize market impact, not move the markets. Top of book liquidity is often quite small and seemingly gets smaller by the day. Market makers are very wary of posting any major size on the inside market. So you need to be careful around how you're executing and nuanced in terms of how these orders are being placed. So in terms of some quantitative intelligence and some of the things that we're looking at when modeling out how child order placement operates, and how we're forecasting, how liquid a given market is, how we want to look at volatility, compare historical models to what's happening during the given trading day. We're looking at a lot of different factors, things like, trade sizes, across time, across different buckets. So in terms of demonstrating just the importance of, using tools like this and, using the, historical intelligence and randomization anti-gaming features, looking at several different markets across a variety of commodities, The most frequent trade size is one. In many markets, looking up to the 75th, 90th percentile, the average trade size is one. The overall average is going to be slightly higher than that, but often significantly less than 10 contracts. So for any given execution, anything that's different than one is going to look interesting to the market. And they're often going to react to that in a way that is going to reduce liquidity temporarily. That might be a human trader. You might be placing a trade on the screen, crossing the spread to take out your full quantity. The rest of the market's not going to know that, obviously. You may also have very large trades. That's kind of the classic example of using these types of tools that you want to spread out over time, because obviously the immediate liquidity is not available. If that is being done in a way that looks different than some of these historical distributions, then you're also giving a signal to the marketplace that there's potentially associated size that's working and that people can begin taking advantage of. So looking at just a sampling of these markets, corn and soybeans, tend to have a larger average size here because those are pro rata markets. Brent crude, coffee, and Matif rapeseed, you're looking more at FIFO markets. You can see that the average trade sizes are typically going to be closer to one, with a standard deviation around that size, just indicating that distribution is really heavily skewed. But other than a few kinks in some of these around some of the round lot sizing, this is really meant to demonstrate the importance of how we're looking at slicing up orders when they're being placed with the different premium order types. So using something like a T-lot plus isn't simply going to be, place a 5-lot, wait till the end of a certain time frame, cross the spread if I haven't been filled. It's really more about passively working, more normal, realistic looking orders to the rest of the order book, trying to hide your footprint, working those passively, really making a one-sided market around things in order to improve the overall quality of that execution. The other thing, aside from trade sizes, that I wanted to just briefly take a look at and demonstrate, and these are among a number of factors that we're often looking at and that are being built into our models. Along with the team, we're hoping to put out some more literature around how we look at things. But just looking at the inside market, this is just a recent sampling of the average top of book quote sizes across the same set of markets that we were just looking at. So on the x-axis, it's just the top of book size, pretty much in one quantity increments all the way to the end, which is just a all else bucket. So looking at ZS and ZC, again, these are pro rata markets. They're showing a wider distribution of that top of book quote size, which fits with the overall matching algorithm and rationale and how people are executing in those markets. You need to quote bigger size to get a bigger proportional amount to get your overall fill, to get those leveling fills, which are often advantageous, and certain participants are creating their own strategies specifically around leveling fills. So knowing that and understanding how that process works is important in how we look at sizing those child orders within pro rata markets. This is in contrast to orders in some of the FIFO markets, where you can see in the crude oil complex, looks like roughly 30% of the time the inside market was a one-lot quote. There are some fat tails here where you may have a large quote size that flashes But as you can see, this distribution, while less extreme than the trade distribution, indicates a high tendency for very low quote sizes. So if I need to execute rather quickly, or I'm looking to minimize market impact, it becomes very difficult to take liquidity without moving things around when the inside market's only got one or two lots available, and I'm trying to execute 10, 20, 100, 500. Coffee and rapeseed, as the other examples I brought up, even more pronounced. Here we've got roughly 70 and 60% quoting at one lot on the inside market. Again, this is recent active month data, but really just trying to demonstrate that across time, across dates, this tendency will hold. Obviously, there are going to be economic reasons that things might shift and change, but the reduced visible liquidity on inside markets is something that has been growing in futures markets for quite some time now, and really makes the types of order types that the premium order types are providing you an important tool in your ability to be able to execute efficiently, access liquidity, and minimize your overall footprint against the marketplace. So quickly, rather than continue going through a number of different slides, often it's best to pull up and really demonstrate how these would be interacted with within your own trading platform. So the great thing about the TT premium order types is they're accessible in the same way that you would currently be accessing any of the standard exchange order types or other TT order types, which really benefits from being able to fit within your workflows. I've just got a quick test environment that I like to pull up here to just walk through how things look and how you can use these in different scenarios to provide some practical examples of execution. As I mentioned, the premium order types are going to be within any of the existing widgets you use for order placement, whether that's MD Trader or if you're pulling up an order ticket off of a market grid. In any case, when your accounts have access to these, they're available via your drop downs. And then, that opens out access for some of the additional optional parameters that you can utilize within these. To go through in a little bit more detail on some of the parameters, when I mentioned the scheduled and opportunistic bucket of order types, the opportunistic component of that, when we're looking at things, we expose within an aggression parameter in terms of, how tightly we want to follow a given schedule or how much leeway we want to provide to that in terms of being opportunistic. So, low aggression is typically just going to allow the order type more time to manage its own, against the order book and try to capture passive fills, be opportunistic, potentially get ahead or behind based upon those dynamics. So when I pull up any of my order types, I get these, these optional parameters. That's not what we want to go through. We want to go through usage. So we like to work with clients on getting set up during the onboarding process and really identifying what they're going to be doing, how they're going to be executing, and make it simpler. Working with things like order templates. One example would be from a closing type trade. I might be looking to be trading against the settlement because my benchmark is settlement, or settlement is a physical marking price, and I want to be trading specifically in line with that. I can save those features of my orders so that I've got a settlement style trade setup. So I can specify times, I can specify durations, and save those with settings. If I want to make sure I'm always placing limit orders for some protection, if I'd like to, make sure I don't cause too much market impact, I can, optionally cap that. But really setting this up, I can see I've already got a template saved here called energy close. But if I wanted to, create a new setting and say this is energy close limit, I've got the ability to create these different features, save those as defaults, and then really, simplify the workflow as much as possible. Would be to create these custom action buttons that I've got over here, so that when I'm executing within my overall workflow, I don't have to think of the premium order type as, something I have to go and select, jump into, tweak parameters, adjust a whole bunch of things. I can just select my button that I've saved, which makes the process and ease of use a lot simpler. Now that I've created this new button, I can give it a label. And then I've got, within this workspace, I've now got all of these different options for how I might want to execute. So as I said, execution isn't one size fits all. You may have a style of execution that works most of the time and that you'd like to use most of the time, but you may want different options. So VWAP Plus and those scheduled type algos work very well when markets are behaving very normally. When markets are behaving very normally, forecasting is often going to have less variance. It's easier to target, those liquidity models. But sometimes there can be, sudden events or some change in the marketplace. Maybe I want to switch to a TWAP plus because I'm not really sure how this is going to look, or it's an overnight period and it's quite a liquid. So I just want to kind of spread something out pretty evenly to take advantage of that, or to avoid the inconvenience of the fact that I'm not really sure when anyone's going to be showing up in size. I might want to switch to a POV style algo because I really just want to react to the market. I'm not necessarily sure how liquid something's going to be. Maybe there's a reason that today is going to be significantly different. We've got EIA reports, or WASD, or some other commodity linked report coming out, and I'm not sure how something's gonna come out. So I just want to make sure that I'm participating in the marketplace once that number is released. So I know I want to buy, and I want to start buying at 8:30 in the morning Central Time, and I just want to execute at 8%. I've got 200 lots to do. I'm not too concerned about what the how long that's going to take, as long as I'm targeting that participation rate. With that, with the types of event risk that are coming out, those are things that are additionally built in to the quantitative intelligence, looking at how those types of reports change the overall liquidity profile. So there's a multitude of things that are looked at and then filtered. So there's kind of the standard, what is the normal day looking like, and then you've got the special days where you've got releases at specific times where there are distinct changes to the overall liquidity in the marketplace. Obviously, how people react to those from a pricing perspective is going to determine on the contents of those reports, and how the contents come out might affect liquidity. It's certainly going to affect liquidity to a certain extent. But typically, there is going to be, an increase in trading activity around those numbers. It'd be, have to be a very muted report for everyone to sit back and say, okay, we'll just continue trading as if this is any other day. The information content is very important as that's coming out. And then specific to our Brisk algo, we do have a feature that was originally intended and built with commodity traders, basis traders in mind. And it's called the Brisk limit mode. So as I was going through Brisk briefly earlier, I mentioned that it's really looking to kind of solve the problem of optimizing between market impact and price drift. Those are really two components of the overall execution problem. The third component is typically going to be execution risk from a size perspective. So most participants in any market are going to have a firm limit price at which they're looking to execute. That limit price might be more aggressive than where the current market is. But as you're trying to work size, you don't want to eat up all the liquidity before you're able to get your order filled. And you want to keep that in mind when you're slicing up the order, that you've got this price in mind. So Brisk limit mode is a parameter feature that we introduced basically to inform the order that there is some reason that I would like to get more aggressive as I'm approaching my limit price. So there are options that you can set to inform that behavior to get more aggressive as I'm approaching that limit price. A lot of that's going to be driven based on the same modeling that's just driving the order types overall. So how volatile is a product? Products with high volatility. So commodities certainly are typically going to fall into that bucket more often than financial markets or FX or interest rates. So the more volatile any given market is, the further away from that limit price it might begin kicking this behavior into gear. So if a market tends to exhibit volatility in the 10 to 20% range, maybe it's going to be a bit farther away from the market that it starts saying, I want to get more aggressive. I want to start taking some liquidity rather than just passively working it, because there is that risk that the price can drift. And I'll be left, hung on some additional size that I'd otherwise like to get done by this limit price. So the economic concept behind it is, a good use case would be you've got a physical basis, the futures price at which that basis becomes flat, or even into the red. So you'd like to use that as your limit to make sure that as you're executing your futures at the market, if the price begins drifting and you're still trying to work that quantity, you can get a little bit more aggressive if it's approaching that, and try and make sure you get that differential locked in. And I'd briefly like to walk through Prowler, the TT Prowler type as well, just because this has been a somewhat common and interested use case amongst a number of traders, given that icebergs are quite prevalent, and it's a little bit easier to understand, less of a gray box. So as I mentioned, TT Prowler is an advanced iceberg style order type. So it offers a number of different features. We look at things like min show and max show to add some anti-gaming, to make sure that other participants can't, are less able to identify iceberg activity. You don't want to continually go back into the order book with a common order size. That's what a lot of market makers and liquidity providers would be looking for, so that they can inform their own trading models that things need to fade. That there's some liquidity that would be toxic to them. We've got the posting capabilities, so the ability to follow the market. So you don't need to just post an iceberg at a limit price. You can post it at the inside market, and if that market moves to a worse price, you can make sure that you maintain a peg to it. You can use a limit price as well to set a max value or min value on that peg. But if you do have that leeway around kind of moving the price around, it gives a nice optionality that you don't need to manually update those prices. You can follow the market if you need to. If it's coming into you, you've got the anti-gaming components in terms of replacing those orders. Posting at multiple layers is very useful in FIFO markets. It gives you the ability to get queue priority ahead of time, so that if a market does tend to sweep through and possibly revert, you have a better chance of getting hit on those orders that are deeper in the book. And then sniping capabilities. So keeping an eye on the opposing quote, looking for liquidity to appear and trying to take that out. There are obviously certain times that certain participants might be willing to show more size on the book than maybe they fully intend to be executing. Pro rata markets, obviously, with how the matching algorithm works, in order to get a certain amount filled, people may be sizing up in excess of that, and that gives the advantage that if needed, you can access that liquidity by taking that out. So the I would quantity and with it to quantity are really features meant to initiate liquidity taking measures in order to take advantage of those situations. So in terms of the overall workflows, TT premium order types fit nicely within, and we like to think that by streamlining the opportunity to use these, it should simplify the process of getting these into your overall workflow. There's a number of different components that we're looking at working on in the future, in terms of integrating these with further tools within the platform, with new tools within the platform. We've also got some new and upcoming features that we're excited about for 2023, and always looking to work on improving the tools that we're able to offer clients, improve how we're using data within these to offer you the best opportunity to benefit in the marketplace.
Thanks very much, Matt. We do have a few questions that have come through. So one of the first questions that came through: would it be possible to develop an order type that could allow us to submit a multi-price level order on one side of the market by specifying the number of levels up to 10, the portion of volume at each price, etc.?
It would certainly be possible. The platform and engine that we develop these order types on, was part of our company previously, which TT had acquired, RCMX. That engine was really built for strategy development, and it's possible to develop any sort of order type and deploy that. At TT, we are looking and willing to do custom strategy development along with any new products that we're offering. Typically, we'd like to just speak to users further about what they're looking for, see if it's something that's already available and possible to utilize with the existing order types or premium order types. And then if it's not, see what the best way of getting access to that would be.
All right. Thanks very much, Matt. Another question that came in: how much data we are using to determine parameters while trading on schedule plus opportunity basis? Can an end user change the time frame of that data?
With the historical data modeling, in terms of specifically how much time, it's going to be multiple different time frames, multiple models that are being blended together. So for things like market seasonalities and forward curve structure and spread relationships, which would be utilized to pick up things like roll cycles, those are all going to be longer term data models. So looking at several years of data to glean out that structure, gets filtered through a number of different things to identify whether or not we've got differences in quarterlies. Even if there are serial months, there might be quarterlies trading more, or there might be December trading more. So that's going to be all some of the longer term models. For shorter term, more around how the shape of liquidity has looked recently and what recent volatility has looked like. That's typically going to be looking at something around the last month. So, on average 20 days. That's currently not something that's configurable. It's just something that's, built into the models. But it's, certainly something that could be discussed further.
The quantity traded data points, you displayed higher levels of one lots being traded. You also show that most of the top of the book is one lots. When you were calculating traded quantities, did you consider whether an order is traded aggressively or passively? If most of the order book is one lots, then by default, most of the trades would be one lots when only looking at passive orders. However, is this true when looking at aggressive orders?
So in terms of the frequency being one lots, that is correct. But if you see the averages, are actually higher. So in terms of that, it's indicating that while the order book is quite consistently small on the inside market, the trade sizes might be eating up more than just that inside market when aggressing. And that is, going to manifest itself in those average trade size, mean trade sizes being larger.
When will ICE products be able to use the new functions?
On the TT library site, we've got the supported markets. So the existing market coverage, which is being expanded to APAC this month, covers most of the North American and EMEA exchanges. So we've got CME, ICE, CFE, Montreal, Eurex, Euronext, LME, and then within the APAC region, SGX, HKEX, JPX, and ASX. So everything is available on platform on those exchanges. For any given FCM or platform admin, there might be some, compliance or some other approval process that you would need to have them enable these for certain markets. So that would likely be a customer specific, request.
Can you highlight where your order is filled?
If I understand correctly, just identifying where your order is filled. If the question's within something like a market grid or a chart, I don't believe that's currently there. Within the order book, if I'm, executing any given trade, I will have certain information that's coming back, within the platform. So let me just get an order in. So within the order book, I'm going to have a parent, my parent order. Within that, we'll have nested child order information. So, this information is going to be updating with your, filled quantity. So how complete am I? Average price on that parent level. So this would be the main source of that information available real time within the platform. And this is, we're looking to expand some of the metrics available associated with the premium order types. So some things like realized participation, some simple slippage metrics. So hopefully that answers the question of highlighting where you're filled.
Since you're on this workspace, another question came in. Are the parameters on the premium order types, can you cancel and replace them?
Yes. So as you can see, if I've selected a working order, I do get the ability to influence any of the custom parameters. So I can update any of these and submit a cancel replace. So if I wanted to increase my aggression, or if I wanted to update a time or add a cap or move this to market, I can submit that change. So this, now has updated, to all of these. So then if I reselect it, it'll show me what parameters were working. If I'm working something on an MD trader ladder, I can use a lot of the same functionality and in terms of how I can move this around. So if I'm working a limit order, I can update the parent in the same manner as any other order by right click, drag and drop, or whatever your settings are set to. One caveat on the MD trader ladder is if I'm working something that's a market order, because a market order doesn't have a price associated with it, that parent level order is not something that is going to be appearing, with the ability to interact with. So the order book would be needed in those instances.
This is a question on just the order types in general, but they're saying, for example, TTPOV, how is this different from a same logic made on ADL? What upsides do we get through the premium order in this case?
In terms of something made on ADL, typically that's going to be something that one, you need to build, and then two, you need to maintain. In terms of the premium order type, this gives you the, pre-canned solution available within, all of the widgets you're looking to execute from. And really the quantitative intelligence that's driving these. So reducing the need for yourself to go in and do all of the specific execution modeling work, and really focus your time on the strategic aspect of the trading. We like to think of this as an important tool in your toolbox. The more time that users can spend on identifying good trading opportunities from the portfolio or firm standpoint, and the less time they need to spend on tools to influence how best to implement that trade, the better. So it's really looking at providing that advanced tool set with the quantitative background, so that you don't need to sit inside of ADL to build something like that.
Do premium order types run on dedicated servers?
Yes. So the premium order types are run on dedicated hardware. As I mentioned, the specific technology and engine running these was a proprietary technology that TT acquired when they acquired our predecessor firm. But yes, it is going to be on something that's not specifically tied to the general population pool of servers.
Are the premium order types available in the TT AutoTrader widget and TT.NET API?
So within the TT Auto Trader widget, not currently. That is currently, I think, dedicated to the TT algos that a user would build. We are looking at the use case from customers for making sure that these are available in any component they're looking to use them. TT Premium order types are available via the .NET SDK and the Fix APIs. So they are accessible if you're looking to automate something within those, as well as on the TT workspace.
As TT are open to offer and deploy more order types, how would those orders be different from regular TT natives?
I think that is a bit outside the scope of what I'm looking at. I'm really, on the team working on the advanced execution. Premium order types, are something that is a premium service. So having the dedicated personnel working on things like the quantitative modeling, working with clients on best usage, and kind of building out a larger product suite around that. The difference from just the general TT order types, I think, is going to be, in terms of some of the analytics and service that we're currently offering along with the premium order types. But that's a bit larger scope of a product question than I have purview over.
You've already answered this question. I'm just going to say it out loud, but you have already covered it, and it's on our TT website as well. Since these premium order types are modeled individually, which products do you currently support? So I believe that is already on the website, and you did mention all the exchanges that we support using.
Yes. So I've just, within the TT library, which is a great resource for, a lot of functionality around the platform. We've got a whole section on the premium order types. It includes, some of the some snippets on, what I went over and discussed today, and also gets a little more in depth into the different parameters and how those would influence any of the behavior. Along with this, we've got a supported exchanges and products list. This is continually updated, so we've got a couple new exchanges coming online. Those will be added, and then as we add support for any products, as clients request them and we're able to model them in, they'll be added to this page. But in terms of current coverage, broadly cover the major liquid products on most global exchanges. And in terms of getting additional products added, we typically just ask that a client open a ticket, with that sort of request, so that we can track that from a support standpoint and provide updates. There are certain products that we have declined to cover in the past, just due to the horribly illiquid nature of them in certain cases. But we're always happy to look at expanding the usability of these across markets that clients are demanding.
All right, we will do one more question and then we're going to close this call. Does VWAP Plus or Brisk have any dynamic logic for a market that moves outside of a limit and comes back in? I've had issues using similar strategies in the past where that happened and the algo attempted to catch up immediately.
Yes, so we do have certain behaviors around how to handle limit prices. Most of that is dependent on what the trading horizon is. So if you've got a firm, and if you supply an end time on an order, that's something that needs to be honored. If we haven't reached the end time and there has been price movement in and out of a limit price, we look to avoid doing anything that's just an immediate catch up to where I think I should be in terms of quantity. We prefer to smooth things out, effectively reschedule the entire order from that point, and begin working within the same logical framework again. Catching up, being at limit prices, that's one of the fine lines within any execution strategy. And you typically don't want to do anything too quickly because you don't want to be the reason that it then moves back out from your limit price.
Well, thank you very much, Matt, and thank you everyone for joining. We hope this was very helpful to you. If you have any further questions, please feel free to email it to us. With that, we will close this webinar. Thanks again for joining. Have a good day, everyone. Bye.
Thanks, everyone.